Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So most of us are familiar with what it takes to measure our profit. What we take home at the end of the day in our business is a function of two things, fundamentally: revenue and expenses. I call this two-dimensional profitability, right? It simply takes one linear equation: revenue minus expenses equals profit. Really simple. This can be measured for any period of time, like a month, a quarter, or even a year, right? And any period of time. However, a lot of businesses that are profitable still fail. How can this happen? How can you be profitable but drowning? I'm going to tell you a story I heard from a colleague that illustrates this. And I don't have all of the exact details, but I think this will ring true and you'll understand exactly how this happened. So his client ran a business and she would sell services and invoice her customers. So let's say each service costs $1,000 and it costs her $600 in labor to offer it, right? I'm not going to make you do any word problems, don't worry, but just understand that this is a service where the main cost is contract labor, right? Each service, though, is profitable. So you can tell if she's charging $1,000 and it costs her $600 to offer it, she's going to make $400 per service, right? Linearly. So like, how does she run out of money? Well, the invoices had a due date in 30 days from the point of sale. Sales happened to roll in for this particular offer toward the beginning of the month because her customers had a bit more disposable income right after their paychecks cleared. Now, they had the high disposable income, and of course, they're more likely to say yes to this service. Now, the terms on the invoice, I'll say again, were net 30, we call it, which means you can pay within 30 days, basically. The contractors providing these services that she pays would get paid on the 15th of every month. Now, I'm not going to unpack exactly what happened here, but you can probably figure out that she sold a bunch of stuff verbally at the beginning of the month, had to pay her contractors for all those services the 15th, but didn't collect until the end of the month. So that means that she was paying before she was collecting. And what ended up happening was that this client had terrible cash flow. Each month, no money would come in until the end of the month, but all the bills had to be paid. And then many clients would not make their payments or they'd pay late. And this left her not only unable to pay herself, but she was pulling money out of her own account to make the payroll. And this is the power of cash flow. It is about switching from a two-dimensional profitability model into three-dimensional thinking, adding in the dimension of time. So cash flow is like your business's metabolism. It's the pace at which your business processes the ins and outs of cash through your different accounts. You can have, let's go back to fitness. You can have a calorie deficit if you're trying to lose weight. But if you have crap metabolism, you still don't lose weight, or you don't lose as much as you want. And this applies to your business too. How we measure our cash flow is very simple. It involves understanding how money comes in and out of your business. And I'm not talking about just income and expenses. I know that is where everyone goes, but I'm not just talking about income and expenses. So there's actually three types of cash flow. Okay. This is as technical as I'm going to get, but I'm going to go through these three types of cash flow with you, very, very, very basic level, so that you understand that there's three different ways, three different doors that money is coming in and exiting your business. You are manning one door going, what are we talking about? Everything's fine. But there's other doors that you're not thinking about. So first, let's go through the door everyone knows, which is called operating cash flow. This is just the cash the company makes or spends in its day-to-day operations. This is your basic income from customers and expenses that you see on your P&L. This includes paying your employees, purchasing supplies, all that stuff, right? So this is the ins and outs that we're all kind of thinking of when we think of profit. Second, there's investing cash flow. This refers to cash movement from buying and selling assets like property, equipment, investments. And for example, if a company buys a new car or invests in another business, that's investing cash flow. So if you're purchasing assets, you're buying new machinery, you're buying new office equipment, that is investing cash flow when you're purchasing assets. Lastly, financing cash flow. This is the one this is the silent killer. This is the silent killer. This is the cash that a company makes or spends in raising capital or paying back loans. But this also includes distributions to the owners. This is the silent killer. Why this matters: you may have a positive cash flow from your operating activities, which is your basic income and expenses. But if you have debt to pay, or if you're pulling money out of your business to fund your lifestyle at a rate that your operating cash can't support, then you're actually draining the business of its cash every time. I'm going to say that one more time. This is, by the way, if I had to say there was a vital sign, when someone is ill and there's different vital signs to show that they're, what their health is, a business's vital sign to me, one of the biggest ones, is answering the question, does your operating cash flow support your distributions? I'll say that one more time. Does your operating cash flow support your distributions? And what I'm actually asking with that question is your business bringing in enough profit? Are you making more than you're spending in your business operations? And are you distributing, or are you pulling less than that out? If you are pulling more out than your business can produce, then you are basically pulling from your business and it is draining. You are pulling more than what it can make. And because of that, it's going to deplete your cash. And you might be wondering, Shannon, how can I pull out more than it makes? Because you started with cash. Because every month, if you make profit, there's cash in the bank account. You don't start every month with a zero bank account balance. There's money in the checking account. And the problem is that you can't see with your two eyes how much of that money was actually produced by the business last month, or how much was produced in any given period of time. Like how much of that was income versus you injecting capital into the business or raising capital or getting a loan. Like you can't really see that. And then I'm going to give you a little tip that I use. I have a line of credit right now in my business, not for any necessity, but because I love having leverage. I love having a little extra cash I can spend at a very low cost interest rate. So in my line of credit, I actually have this rolling line of credit here, and I put it into a separate bank account. So I don't touch it. I don't treat it like it's mine. I don't treat it like it's my money, because I know that as fast as that cash flowed in, I will also be flowing it out over time, and I'll be flowing it out in large chunks. So I have to make sure that I always have the money in there and that I'm managing my cash flow by understanding that in the future, that money will need to be there in order to be taken out. So I have to make sure that it stays there. So I actually keep it in a separate account under Relay, which I love, by the way, as a business banking platform. They actually work with Profit First. So if you're into that, go check out Relay. But in my Relay accounts, I basically put in my line of credit as a separate bank account, because I just don't want to look at my overall bank account balance and think I have more money than I do, because it's not at my disposal. So if you need that type of discipline, I highly recommend having multiple bank accounts in order to manage this. And here's the other tool that I think that everyone needs in their arsenal. Every business owner needs in their arsenal in order to really understand your business's health. And that is a cash flow forecast. It sounds fancy. It's really not. And this tool can help you predict what will be coming in and going out, and when. Again, three-dimensional, and when it will be coming in and going out. So you can actually predict how your bank account will look weeks or months into the future. I actually find it's easiest to start with a projection out for like a few weeks and then expand that into months. It's just much easier to predict a few weeks out than, let's say, the next year. And if you'd like a head start, you can grab a copy of my cash flow forecast template now in the show notes. I'm actually going to be having a part 2 to this episode tomorrow, and I'm going to cover how to use what you uncovered from today's episode, how to understand your cash flow a bit better to actually maximize it and to improve your cash flow of your business. I'll see you then. I can't believe how many episodes we've released of Keep What You Earn. There are literally hundreds of thousands, if not millions of dollars in tax savings contained in our episode library. And there are so many topics that we cover. To make it easier to find more of what you need right now, we actually created a custom curated playlist just for you. That's right, a playlist of value-packed episodes that you're looking for based on your goals right now in your business. Whether you're making your first sale, trying to strategize your taxes, or you're scaling your team, there is something here for everyone. Check out the podcast playlist generator now using the link in the show notes and explore your custom playlist. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.